to make the definition very simple, something trades on an implied volatility discount when the implied volatility price is below the realized 30-day price. So again, of volatility. Now again, that's using futures and options, and again, volatility to understand the complacency and or capitulation of bulls and bears. Now complacency is one thing. So again, if the market is no longer expecting volatility on an implied basis going forward, having realized a ton of no volatility looking backwards, that's called complacency for bulls. So again, if you've made a ton of money, and again, congratulations if you bought stocks on Thursday morning or into the close on Wednesday, congrats, and God bless you and your family because now you have more money. But again, that is yesterday's news, 3 days old now. We have an implied volatility discount. That has not happened. Look at that chart one more time. This has not happened yet. You'd have to go way back to find one of those. Now again, that is a gnarly looking thing. Again, price, volume, and volatility are the hallmarks of the Hedgeye process in terms of daily measurement. So again, price, volume, and volatility. So again, these three things, the rates of change of those, how they look on their own, how they look individually, how they look on their own individually is the same thing, how they look on their own individually, how they look as a group, how they look across durations within fundamental macro themes. This is how you do the macro. So again, this is critical this morning to be realizing that front month volatility has fallen back to 10, implied volatility discount versus 30-day realized, and you have net positioning is not like totally agreeing with both of those things. So it says over here, don't pay attention to that, and volume down double digits on the up move. Good time to be booking some gains and selling some stocks after making a lot of money in the last 3 days. It has been the data, guys, that has been driving this train. Look at the equity earnings data. Look at this. I think we had this morning, the earnings scorecard. Do you have that, Josephine? Mm-hmm. You don't have to squint. It's just a big green arrow. Everything's green. I mean, what else do you want? It's just green. I mean, S&P earnings up 15%, NASDAQ up 17.4%, Dow earnings, if you're a Dow bro guy, up 14.4%. I mean, if you're underweight the Russell, good, because we've not told you to buy the Russell. We told you to buy the Russell Growth, which is outperforming that. But this has been fantastic. This is the most unreported reality that you can see quite clearly. One of our favorite sectors is technology, continued to lead to the upside. You can see that XLK was up more than the stock market by 30 basis points. So the stock market was up, S&P 500 was up 50 basis points, and you see the technology sector was up 80 basis points. So that means that technology, once again, is generating the alpha for active managers who want to have better returns in the market. So again, stay with tech on all pullbacks. We would not change that. Again, we're not telling you to buy it today, but on pullbacks, tech up over 15% for the year to date continues to echo that growth accelerating remains a fantastic equity exposure to have. Now, if you look at defense spending, we've been saying routinely throughout the year and really since Trump won to be long defense stocks because the budget is one of the few components of government spending that is decisively going to go up. So that's been the research call. Emo Gardner has nailed it. The stocks are at I think they're back to the highs, and they're signaling immediate term trade over buy. So I do think that there's a chance that they pull back because the greatest chance of something pulling back is what? It's not Trump. It's just that they hit the top end of the range. That's the point. That's why time is much more important than some spatial valuation concept on what a stock should or should not do.